The weak yen is becoming Japan's new normal. For decades, the Japanese yen was regarded as one of the world's safest currencies. During periods of financial turmoil, investors typically sought refuge in the yen, expecting Japan's stable institution and large external asset to protect its value. That assumption is now being tested as the yen sinks to levels not seen since the mid-1980s. The debate is no longer about whether the currency is temporarily weak. The more pressing question is whether Japan has entered an era of structurally persistent yen depreciation. The recent slide has been remarkable. At the end of June, the dollar traded above 162 yen in New York, the weakest level for the Japanese currency since 1986. The comparison inevitably recalls the years surrounding the 1985 Plaza Accord, when coordinated intervention by the United States and its major trading partners dramatically strengthened the yen. Yet today's circumstances differ fundamentally from those of 4 decades ago. The forces pushing the currency lower are rooted less in exchange rate policy than in deep changes within Japan's own economy. The Japan of the 1980s depended heavily on manufactured exports. A stronger yen threatened exporters, prompting aggressive monetary easing that eventually contributed to the country's asset bubble. When that bubble burst in the early 1990s, Japan entered decades of sluggish growth, low inflation, and exceptionally low interest rate. Despite the prolonged economic weakness, however, the yen maintained its reputation as a safe haven asset. That reputation has gradually eroded. Since 2022, the yen has lost more than 30% of its value against the US dollar. Measures of the currency's real purchasing power have fallen sharply over the past 3 decades, suggesting that the yen buys far less than it once did, even after adjusting for inflation. Investors who once viewed the currency as a reliable store of value have become increasingly cautious. Structural change help explain why. Japan today earns enormous income from overseas investment rather than merchandise exports alone. The country continued to post substantial account surpluses even when its trade balance slipped into deficit because profit, dividends, and the interest earned abroad remain strong. Yet a growing share of those earnings is reinvested overseas instead of returning home, reducing demand for the yen. A country can remain wealthy while its currency weakens if much of its wealth stays outside its borders.